Returns on real estate can be infinite if you pay no money down. In this episode, I'm going to enlighten you by answering the question, how to calculate return on real estate investments. Now, I've been doing this for more than 46 years, so get ready. I'm going to share some things with you that you've probably never heard before. So my name's Doug Andrew. I've been a financial strategist for more than 46 years. I happen to be here in my radio studio. I record a new radio show every single week. I've been doing it for 12 years. It's broadcast on several stations in America. Prior to that, I started writing books at the turn of the century. I've written 11. I'm going to write a book every year the rest of my life is my goal. But as you continue with this education on this episode, if you want to learn more in depth about what I'm talking about, make sure you click on the link below and seize your free copy of my most recent best-selling book that retails for $20. You contribute $5.95 towards the shipping and handling, which is usually a little bit higher than that. And I'll send out a book to you absolutely free. So make sure you claim your free copy. So let's talk about how to calculate rate of return on real estate. Now, first of all, real estate, when you put money into a property, if you pay cash, which I have never done, I've never paid even a down payment for any piece of real estate that I've acquired, and you're going to understand why here. But if you pay cash, let's say for a duplex, a rental property, and let's say you paid $300,000 cash, and then you sell it 10 years, let's say 10 years later, for $600,000. So you paid $300,000 cash, and you sell it 10 years later for $600,000, and you go, I doubled my money. Now, first of all, when people say, I doubled my money, that doesn't impress me until I know what? How long did you hold on to the asset, and did you pay cash, or did you leverage using OPM, other people's money, borrowed money, okay? Now, if they say cash, I go, oh, that's easy. So you held on to it for 10 years and you doubled your money. 10 years into the rule of 72 means that you earned an average appreciation on that of 7.2%. I've done that many, many times. That's ho-hum. That's not anything to brag about. If you pay cash and you sell it for double, you divide the number of years it took for you to double your money into 72, and that will give you the compounded interest equivalent. 7% is not anything to brag about. Now, if I say, if you leveraged, if you used some or all of OPM, other people's money, the bank's money, now we're talking. So what does that mean? If you paid 20% down, let's say on a $300,000 property, 20% would be $60,000 down, and you went out and borrowed the remaining $240,000. Now it depends upon, well, what did you pay in interest? Well, I borrowed at 6%. Well, did you deduct the interest on Schedule E or on the LLC or whatever? Yes, I deducted the interest. So between federal and state income tax, what is your marginal tax bracket? Because you get to deduct the interest you're paying off of the top, off of the last dollars you earn, so you use your marginal tax rate. Let's say between federal and state it's 33% or a third. So if you borrow money on real estate that is tax deductible, because you did it right, it's not costing you 6%, it's costing you 4%. See, it costs you 2/3 of that because you're able to, let's say on a $1 million property, 6% would be $60,000. You can deduct $60,000 of interest that year, but you are saving in a 33% bracket 1/3 of $60,000 or $20,000. You actually paid $20,000 less in tax because you deducted $60,000 of interest expense off of your tax return. Does that make sense? So the net cost of borrowing money on real estate is based upon your marginal tax bracket. But if you're in a 33% marginal bracket, if you borrow at 6, it's really only a net cost of 4. If you borrow at 4.5%, it's a net cost of 3. If you borrow at 9%, it's a net cost of 6. Well, for years, if I borrowed at 6, a net cost of 4, In my indexed universal life insurance policies where I keep my real estate equity, I've been earning 8 to 10. Let's just say 8. I've been making 8%. So on money that would otherwise go into an unnecessary down payment on the real estate acquisition, I keep it over in my laser fund. This is where my money is growing tax-free. You can learn about it in a book that I'll gift you at the end here. I've been earning 8%, 8.2% for the last 46 years. The last 25 years, more like 10.07%. Let's just say 8. Okay, now let's do the math. So let's say on $1 million mortgage, I am earning $80,000 tax-free by not paying the mortgage off or paying a huge down payment. I don't care. Let's just say on $1 million of real estate equity, if it's in the property, it's only going to do what it does. If the real estate goes down in value, I will lose. I guarantee you'll lose money when the real estate goes down. If the money is over in my insurance contract and the real estate market goes down, I don't lose a dime. I keep earning 8%. I earn $80,000 the first year. The next year I earn compound interest on $1,080,000. But I'm making 8%. What's the cost of the mortgage? A net of 4%, $40,000. Wait a minute. By having a mortgage, it cost me $40,000, but I'm making $80,000, or a net of $40,000. How much more is 80 than 40? 100% more. Let me put it this way. Would you hire an employee for $40,000 if that employee made you an extra $80,000? Oh, I'll do that all day long, because they're making me 100% more than they're costing me. Would you buy a widget machine for $40,000 if that widget machine made you an extra $80,000? How many widget machines would you buy? As many as I can get. That's called 100% return on employment cost or equipment cost. So by not putting a down payment into the property, I keep earning 8, 10% rates of return, and I pay a net cost of 4%. When I borrow money at 3%, in a 33% bracket, it only costs me 2%. Every million, I only shell out $20,000 a year in interest, but I've been actually making 10%. How much more is 10 than 2? Don't say 8, it's 500% more. I make $100,000, it only costs me $20,000. That's like hiring an employee for $20,000 that makes me an extra $100,000. So how does this all come together? When we talk about safe positive leverage, which by the way is the third marvel or miracle of wealth accumulation that I talk about in this book that I want to gift you, the first miracle is compound interest. I am earning compound interest tax-free over here in my laser side fund, and I'm paying simple interest tax deductible at 2, 3, or 4% net cost over here on my real estate mortgage. Why would I ever want to send extra principal payments? Because I would be giving up 100 to 500% rates of return. And so I actually get out of debt faster by not giving it to the mortgage company, by keeping it earning way more than it's costing. But this is what banks, credit unions, they borrow our money and they pay us 1%, and they turn around and put it into the same place I'm telling you to, into insurance companies, and they earn 5, 6, 7%. They're making 500%. When you put money in a savings account, I'm making 500% by doing what I'm telling you. We're both happy. You wouldn't believe how many people don't understand what I just said. This is how money works. And so the function of leverage, okay, compound interest is the first miracle. Compound interest tax-free is the second, but the third miracle is safe positive leverage. The ability to own and control assets like a real estate property with very little or none of your money tied up or at risk in the property. Because if the property goes down in value, you will lose. If the money is over protected in the insurance contract and it goes down in value, you don't lose. I've been doing this for 46 years. And so when we talk about it, this is what makes the world go round. And when you do that, you have 100% liquidity. If I get into trouble, if I get laid off, if I get disabled, and my money is trapped in a property that I've been trying to pay off, there's only one way to get that money out of there. That's to borrow it back or sell it and prove there's a need why I need the money. I don't have to worry about that at all. When it's over here in my liquid laser fund, I just make a phone call. I make an electronic funds transfer and I can have the money. Let me give you an actual example of this that happened to me in 2009. So back in 2007, December, I could see the writing on the wall that we were headed for sort of a mortgage meltdown, and sure enough, it happened. So I borrowed 100% of the equity out of my house because I have good enough credit to do that. Back then, the home I'm talking about was worth $1.5 million. So I had $1.5 million of my equity out, earning compound interest tax-free. Guess what happened in 2008? Bam! In 2009, my house that was worth $1.5 million just over a year earlier was now only worth $1.1 million. It dropped in value $400,000. If I had left my equity in the house, I would have for sure lost $400,000 for about 7 to 8 years before it came back. I didn't lose a dime of that because it wasn't trapped in my house. It was over here in my laser fund, and it was earning 8%. 8% on $400,000 is $32,000 a year tax-free in the very first year. The mortgage at 6% tax-deductible interest was a net cost of $4,000. On $400,000, that was $16,000. So on the equity that was not in the property, it was over here safe, I was earning 100% more than the mortgage was costing. It was costing me $16,000, I was making $32,000. I just peeled off $16,000 out of the $32,000, and I was making 100% more than the cost of the mortgage. And yet people said, "Oh, neener, Mr. Andrew, you're underwater. You owe more than your house is worth." Did I care? I'm in control. People were losing their homes in foreclosure. I'm like, no, the mortgage company loved me. I never missed a payment. I took a portion of the interest I was earning, and it made my entire mortgage payment, and I still had 100% more than that. You will actually get out of debt faster by accumulating your money over in a side fund. I can prove to you, you'll pay off your house 2.5 years faster. But if you want to calculate rate of return on real estate, if you pay cash, it's a simple, pathetic return. It's a rule of 72 calculation. But if you leverage, you finance 80% loan to value, now we're talking. But if you do like I do, I don't put one dime. I've never paid a down payment for any piece of real estate that I've acquired. I've satisfied down payments, but never with my money. I leverage. You leverage with full liquidity. If you do not have liquid money, leverage without liquidity is stupidity. I had the money, I just didn't tie it up in the property. I put it over here, compounding at a higher rate of return than the net cost of the mortgage, and I was making 100 to 500% rates of return. If this is beginning to arouse curiosity, you have no idea how huge this is over the long term, how this creates millions of extra dollars that most people just pour down the drain by sending extra principal payments against their real estate. So you can have infinite rates of return on your real estate when you do this, when you become your own banker and do what banks and credit unions do. I want you to learn about this in this book or any of my previous books. If you go to Laser Fund, laser means liquid asset safely earning returns, laserfund.com. In fact, all you have to do is contribute $5.95 towards the shipping and handling. It's usually a little bit more than that. I'll pay for the book. It retails for $20. It's 300 pages of charts, graphs, and explanations, and 62 actual client stories. There is a chapter on the orange portion of the book that actually talks about real estate management, which is what I've been addressing in this video. So this is the left brain side, charts and graphs. This is the right brain side. There's a chapter here that talks about how to use the Laser Fund to manage your real estate and increase your rates of return to infinite rates of return.